Welcome back to our channel. So far, 2022 has been bad for both stocks and digital coins. Bitcoin has lost more than 37% of its value over the past year. Ethereum is down more than 41%, and crypto has been in the news lately for all the wrong reasons. Fortune and Forbes say that the industry and its investors are in a panic because of Coinbase's scary first quarter earnings report. Coinbase is the largest cryptocurrency exchange in the United States. For many people who don't believe in crypto, what happened confirms what they already thought. In a new study by Debunked Rates, 40% of respondents said they don't use crypto because they don't think it's regulated enough or they don't trust the security that protects it. Another 60% don't trade crypto because they don't know how it works. This widespread lack of knowledge and trust makes it easy for false information to spread, and there's a lot of it about crypto right now because things are so bad. If you're even thinking about getting into the market, don't believe any of the following crypto myths. 1. With Coinbase, your investments are safe. When Coinbase went public and started trading on the Nasdaq, it gave the industry legitimacy and brought cryptocurrency into the mainstream. After all, the SEC is in charge of overseeing publicly traded companies. This is exactly the kind of federal oversight that skeptical mainstream investors have been waiting for all along. On May 11th, however, Coinbase's first quarter earnings report showed that the company had lost close to $500 million and that the number of monthly users had dropped by 19%. Then there was a sell-off, which hurt Coinbase even more. After the report, an announcement shocked the business world. Coinbase said that if the exchange goes out of business, the cryptocurrencies stored in its users' accounts could be affected. The people who own them would be treated like general unsecured creditors. Unlike cash, crypto is not insured by the FDIC. In other words, they could lose all of their cryptocurrencies, no matter how well those cryptocurrencies did, if the exchange where they were kept went out of business. 2. There are no rules for crypto. Even though Coinbase is traded on the stock market and is watched by the SEC, a common myth says that the currencies that users store there are not regulated at all. In fact, the SEC said at the beginning of May that it was doubling the number of people it is working to protect investors in cryptocurrency markets. According to Next Advisor, the bipartisan $1.2 trillion infrastructure bill that President Biden signed at the end of last year had new crypto-related tax laws. The article also said that the federal government is seriously thinking about making its own digital currency, and that stricter rules for stablecoin are almost certain to be put in place soon. 3. Crypto transactions are completely private. One thing that turned off mainstream investors early on was that Bitcoin was linked to crime in the dark corners of the internet. The myth says that crypto has always been popular with shady people because it's anonymous and users can make transactions that banks, governments, and law enforcement agencies can't track. After the Colonial Pipeline hack, the government showed that wasn't true when they got the ransom money back. CNET says that at the time of exchange, almost all crypto is turned into fiat currency, if only for a short time. Even though crypto trades aren't directly linked to identities, this leaves a paper trail. Also, all transactions are permanently recorded on a public blockchain, and the technology and methods that law enforcement uses to track illegal crypto movements have become much more advanced. 4. Cryptocurrency is good for the environment. To make paper, trees have to be cut down and a lot of dangerous chemicals, inks, and dyes are used. The gold and silver that were used before modern money were mined from the ground to make coins. On the other hand, cryptocurrency only exists in a digital chain, so it must be good for the environment, right? That'd be great. According to Business Insider, the computer power needed for proof of work mining uses amounts of electricity that could power countries. The New Yorker says that the energy used by the world's crypto mines is enough to power Sweden for a year and that crypto mining can be just as bad for the environment as real mining. 4. Bitcoin isn't just an investment, it can also be used as money. Since the beginning of Bitcoin, volatility has been the name of the game. Investors have had to deal with terrifying drops and exciting climbs on their way to skyrocketing highs. People got rich enough along the way to show that crypto can be a good investment, but Next Advisor says that anything that can make you rich or poor in a few weeks or months is not a good way to buy things. 5. If you pay for a $3 coffee with Bitcoin, but that same share of Bitcoin is worth $30 a week later, you would have lost $27 on a $3 transaction. Gains from crypto aren't taxed. Lastly, it's a common mistake to think that because crypto transactions are anonymous, they're not. The IRS can't keep track of gains and losses and can't tax cryptocurrency investments because of this. That would be nice here, too. In reality, the IRS sees cryptocurrency as property. It is taxed by the agency the same way that gold and stocks are taxed. When you sell, trade, or get rid of your crypto holdings in any other way, you pay taxes on the profits and can deduct the losses, just like when you sell Amazon shares or your favorite ETF. In the same way, tax rates depend on how much money you make, how you file your taxes, and how long you own the asset. If you enjoyed the video, don't forget to subscribe. Thanks.